Welcome back to Alberta Primetime, and the vocal point now. Oil prices are down to about, well, lower than $80 a barrel. What about pump prices? Also in the mix, Alberta at the point where lower than expected royalties will impact our budget. What does our Monday Money panel have to think? Russ Strat was an investment advisor with Canaccord Wealth Management in Edmonton. Shafik Hirani is a director with Investors Group Calgary. And Todd Hirsch is a senior economist for ATB Financial. Good evening, everybody.
Thank you.
Hello.
Good evening.
Oil closed down at $79.17 today. Brent crude dropped $2 to just over $90 a barrel. Todd, what is pushing oil down so much?
I always have to laugh at Alberta. It seems hockey, golf, and watching oil prices. This is our biggest national or provincial sports here. Well, the oil prices are still under pressure these days, predominantly because of what's coming out of Europe. There's nothing good coming out of Europe, and it seems like report after report, bank bailout after bank bailout. There's so much nervousness. Investors are very, very jittery about what's going on in Europe, and increasingly watching slowdowns in China. So if we lose Europe, and tipping the U.S. into a slowdown, we're going to lose China. This is sort of what hangs in the balance right now, and that's what has these oil prices under a lot of pressure. So,
Russ, when you're looking at, well, are these oil prices here to stay? How can you determine that at this point, if at all? If they are going to last, what does it mean?
That's exactly what's on my radar, and Todd made a great point about it being a Alberta pastime, but it really should be if you're watching your portfolio. I mean, it's critical that it hangs on to this $78, $79 level, because there's no coincidence that oil's down 18% today and the junior venture is down 18%.
Wow.
So it's a direct correlation, which is great if you're watching it. If you're not watching it, I mean, you get blindsided.
Well, the venture is where so many of those Calgary juniors, oil and gas juniors, are traded.
Absolutely. So it's a direct correlation. So it's giving people a heads up. So until it forms a base here at $78, and there's no daily support, there's no weekly support, so we need to see what it closes at Friday to see if it's sustainable here at $78. If not, look out.
The thing that people don't understand, Shafik, is we're seeing oil drop, but gasoline prices at the pumps, we're still paying.
Yeah, and I know a lot of people think that there's this close connection, and over the last little while, there's been a bit of a divergence, and what people have to understand is that divergence, there's always a lag between gas pump prices and oil prices, and we are still getting into the summer driving period. So July and August are actually the peak times for gas prices to go up. So I still think you're going to see even further divergence between the two. I think you're going to see oil drop, and I think you're going to see gas prices continue to rise.
Todd, what do you see on the gasoline front?
Really hard to say. Like Shafik said, there's a lot of factors, refining, if refinery is down, or, inventories in different parts of the country. There's so many factors. Oil prices is only one factor, and not even, necessarily the largest factor. I probably see, I agree with that we are going to see more divergence, but if we see these oil prices continuing to fall $75, $70 a barrel possibly, I think we will see eventually some relief at the pump.
So, Russ, keep on going then when we talk about the companies that make this stuff. As an investment advisor, you watch income generation. So you were talking about the drop on the market for commodities as well as companies in the sector. Is it time to get out? Is it time to buy?
Wow, time to get out. That's about 1 year, almost too late. We certainly had a nice surge in October, November, December, but it's certainly relapsed. If you're in it, the irony is my conservative clients are going, what's the problem? Everything's great. Their portfolios are up for the year. If you're in the bonds, debentures, high-quality dividend-paying stocks, you should be in a positive territory for the year. It's the people that are going into companies that don't have those tried-and-true earnings, or they're based on the drill bit finding something. I mean, those are the ones that are in trouble in this environment.
Shafik, it's been weeks now that the Alberta government's projections on oil prices have been far too rosy. They've budgeted on $99.25 a barrel oil. We're a long way off from that. Bad planning by our finance ministry?
Well, no. Todd and I were talking about this. It is a little bit of an over budget, but you have to understand that it's really tough to base a premise based on the price of oil 1 year out. The one thing we have to reflect on is how much it's going to impact the Alberta government, because right now the Alberta government's got a budget deficit of almost $1 billion for the 2012 fiscal year. So they're taking in $41 billion and they're spending about $40 billion. So for every dollar that oil goes down, the Alberta budget loses about $200 million. So if they budget oil at $99, it's at $79, that's $20 a barrel. $20 a barrel times $200 million, that's a $4 billion deficit for the year if it stays at this level.
So Todd, what do you foresee for the provincial balance sheet? Because you can't continue to budget if the money's not coming in. Are we going to see cuts at some point?
Well, it's a really great question. I know this government campaigned in the last provincial election on, no increases in taxes and no major cuts to spending. But like Shafik said, if we end up with a $4 billion shortfall, there is going to have to be some tightening somewhere or some additional sources of revenue brought in from somewhere. And at the same time, the government's under a lot of pressure. The whole Highway 63 thing to Fort McMurray, that's not a low cost or a low ticket item or a low price ticket item. So there's going to be a lot of pressures and a lot of probably pretty tough examinations of budgets going on.
I am curious, though, how some of these provinces can actually use Brent crude prices in their budgets. Everybody I talked to in these interviews for years have been saying $80 to $100 oil, so most people would budget on the lower end. So it is interesting where they get these numbers from.
And if you see a government start pulling back, Russ, do you start, as an investment advisor, making changes to your mentality too?
Again, it's more global. I'm watching oil prices at this point for Alberta.
Next up, Canadians are still spending more than they make. What does that mean if you aren't among the guilty? What does it mean for our whole economy? And can our leaders save us from ourselves? Welcome back to Alberta Primetime and the Monday Money Panel. Federal Finance Minister Jim Flaherty is tightening up mortgage rules. July 9th, maximum amortizations for government-insured lending drop to 25 years from 30, and the amount of equity homeowners can take out of their homes falls to 80% from 85%. Todd, how necessary are these changes?
Well, I think it is a good move, actually, by Mr. Flaherty. There's not really a lot of scope for the Bank of Canada to raise interest rates, so they're looking at, trying to reduce overall household debt, or at least dampen the enthusiasm for households to take on too much debt. They can't really raise interest rates because of the global situation. This is about the only sensible policy tool they have left, and I think, in fact, it was necessary.
Are Albertans among the worst for this, Todd?
In terms of how much household debt?
Yes.
It's hard to say exactly. I would suspect that Albertans in general have taken on more household debt. That's not necessarily a bad thing. Albertans are younger, generally. Incomes and wages are higher here in Alberta, and the labor market is in better shape than almost anywhere else in the country. So if they are a little bit higher here, it's still not great that they're that high, but we are in better shape economically. Yeah.
Right. Russ, what could these changes mean for the real estate market potentially?
Well, I find it ironic that the government gave the sugar and then they're saying don't use this, and now they're pulling it back. I mean, controlling debt's never an issue. I actually heard finally the D word for the situation that Europe's in here, finally. They're in a lot of trouble, but controlling debt for any individual is critical. From an investment standpoint, I mean, I always look at the dividends. Currently, Royal Bank's over 4%. I'm told the payout ratio is very much in control. They're actually increasing dividends. So from an investment standpoint, in the short term, it should be okay. But you're looking at where is the growth going to come from? I mean, it's going to be less mortgages for the bank. So where's earnings going to come from? There's less trading, obviously, going on in these marketplaces. So it will affect earnings for sure. So hopefully it won't have an impact on the dividend on the stock. We'll see. What
about value of the actual real estate itself, Shafik? Maybe an uptick there because of this?
No, Jennifer, I'm sorry. I'm not on that camp, and I know people are looking about real estate going up, but if you look at real estate, you look at three things: demand, supply, and a little bit of psychology. And if you look at the demand for real estate, they base it based on net migration, and the numbers just are not coming in. You look at competitive forces like Phoenix in the U.S., the cost per square foot is a lot lower, and there's historically a 9-month lag between oil prices going down and the value of real estate, and real estate tends to follow. So I'm pretty bearish on real estate right now over the next 2 to 3 years.
Todd, the Bank of Canada Governor Mark Carney, this seems to be public enemy number one in his mind. Are there other things, though, dragging on our economy more?
Well, when you look at Canada as a whole, so much of what's going on globally right now is outside of our control, obviously. We can't affect what's, the nascent recovery in the U.S. We can't affect the imminent financial problems in Europe, and even a slowdown in Asia, if that is, going to drag down these commodity prices. All of these things are beyond Canada's control. Not even Mark Carney, and he's a bit of a rock star, not even Mark Carney can do anything about these things. So for Canada, yeah, we've got some maybe household debt issues, but by and large, Canada, we just have to hunker down and hope for the best with the global economy.
Meantime, and you were talking about banking as they relate to mortgages, Russ, RBC's credit rating being downgraded by rating agency Moody's. Royal Bank is one of 15 major banks internationally, the only one in that set in Canada. How significant is that development?
Well, again, they're going to have to pay more for their debt. I mean, it's kind of like in Europe where they're paying 7%
but the
for their
big
10-year
banks, we
bonds.
think of them as our blue chip stock.
They certainly are the cream of the crop globally, and it just gets to the point of who has the ugliest house in the greatest house in an ugly neighborhood. But our banks are certainly world class.
Shafik, could there strangely be an upside to this downgrading of RBC's credit rating?
Yeah, maybe. The one thing is there's three major rating industries. There's Fitch, there's S&P, and there's Moody's. And throughout 2008, they lost a lot of credibility. They had the U.S. Rated at AAA rated companies. They have all the U.S. banks at AAA ratings. So I think they're just trying to play a little bit of catch up and backpedaling a little bit. And I just worry that they've lost a little bit of their credibility over the last little while. So I think the impact, and I don't know if Todd agrees with this, would be pretty minimal over the next little while.
Todd, what is your take on how significant this development is in the banking sector?
Well, I'd hate to use the word it's insignificant. Obviously, if you're RBC, this is a pretty significant hit. But in the grand scheme of it, I don't think it will actually be that significant. I do think, like Shafik said, the credit rating agencies, I think the pendulum has swung a little bit the other way. Now they're trying to be a little bit, almost too conservative. So if they were not conservative enough before, I think now they're trying to get ahead of the game and maybe downgrade possibly where it's not quite necessary yet.
Which perhaps good for the health of the entire system. Thank you very much for your time tonight, gentlemen.
Thank you.
Thank you.
Russ Dratt was an investment advisor with Canaccord Wealth Management. In Calgary, Shafik Hirani, a senior director with Investors Group, and Todd Hirsch, senior economist with ATB Financial.